Now we're going to come to the platform and we're going to talk about trading VIX and all the different details and nuances about trading VIX with futures, trading VIX with ETFs and ETNs, and also trading VIX with VIX options. And we're going to start by looking at a chart of the SPX. We have the candlesticks here represent the price of SPX over the last year. And I've superimposed in white a price chart of the VIX so that you can see that when the SPX is going higher or stable, the VIX tends to have remarkable stability. But when the market started collapsing back in March of 2020, you could see that VIX started going higher and higher, and it got to a point where the value was extremely high. We're talking about a value of VIX of 80, which is actually it could go even higher. We've seen VIX values of over 100. So this is a very high value. The usual range for the VIX, it should fluctuate between probably 15 and 30, something like that. Anything above that, means that there's probably some panic going on in the market. Maybe the market is sensing that there's a crash about to happen in the market, and everybody starts buying up protection, and that lifts up the values of the options, and that's what creates the volatility in the market. In this case, remember, VIX is measured from SPX options. So in this case, the VIX is reacting to what the SPX is doing. You can see that when it's crashing, the VIX is going higher. And when the market started bouncing back, the VIX started going lower until it settled at a level that's more stable. However, it's a higher level than we had before because there is this feeling in the market that things are not as stable as they were before. Okay, you can see here how the VIX is very reactive. In this case, for example, here the SPX was going higher, the VIX was going lower. This market drop made the VIX go higher, and then it stabilized, started taking off, and the VIX started dropping down. Now we had another market drop here, and the VIX perked up. So we can see that what we knew intuitively, that the VIX moves opposite the SPX, which is a proxy for the US market, is actually true. The VIX, when the market is falling, usually the VIX is going higher, and when the market is stable or going higher, the VIX is going to be stable or even going lower. You can see here the normal values. On the left hand side, we have the VIX values. We can see that it used to be around between 11 and 16. And then after the drop, this is the market drop related to COVID-19, which was a pretty severe drop. After the drop, the market settled at an average of around 25, 26 VIX. So the market, the market is stable now, and we have a stable VIX at this point, but the level of the VIX is it's actually higher, and higher by quite a bit. This used to be around 15. This is now around 25 or 26. So 10 VIX points higher than it was before, and it's very reactive. As soon as we had a little market drop here, the VIX went higher, and it went all the way to 34. So we can see that what we knew intuitively, which is that the VIX moves opposite the SPX, is actually true. Now, we can also look at VIX values. As we know, we cannot trade VIX directly. So this is the VIX. Of course, we have the VIX superimposed, so it's the same price chart. You can see how, look at the size of the candles, okay? They're pretty big, meaning that in a single day, the VIX can fluctuate a lot. That's why the volatility of volatility is usually quite high. If we plot the volatility of volatility, which is VVIX, we can see that in this case, although it actually follows the overall shape of the performance of the VIX. However, the values are much different. Look at how, for example, here, when the VIX was at 80, the volatility of VIX was at 208, meaning that it was expected that the VIX itself was going to have a lot of fluctuation, a lot of variation, a lot of volatility. So the regular range for the VIX is between 15 and 30, but the regular range for the VVIX, so for the volatility of volatility, is probably between 90 and 140. Okay, so volatility itself as an asset class is a very volatile asset. Okay, so it's kind of a little bit hard to understand, but once you get the meaning and the reason why we calculate the volatility of volatility, it's actually easy to understand. Volatility itself is very volatile. Okay, so we're gonna go to the trading page, and we're gonna look at the SPX, which is what we had before. And the first thing we're going to do is, remember we talked about what the VIX represents, and it represents the price range that is expected for over the next year. And if you want to calculate shorter periods, you can do so by using the square root of time remaining until the point where you want to get the price range. So we're going to see this visually. When we go to analyze here and we pick probability analysis, what we have here is the SPX, which is where we're at now, 33.85. And this cone, this probability cone, represents what the VIX or what the volatility is telling us, that by, for example, by the 19th of October, SPX options are telling you that it is very likely, it is 68% probable that the VIX is going, that the SPX is going to be between 29.93 and 37.73. So this is the expected range for the SPX from now until, for example, in this example, October 19th. Now, we can see here that as time passes, the range widens, because we have more time for volatility to act. So this is just so you get a visual understanding of what the VIX, which is the implied volatility of the SPX, what the VIX is telling you about the levels or the potential future levels of SPX. Now we're going to start looking at financial instruments that we can use to trade VIX, and we're actually going to put on some trades, and we're going to see what we can do with them. First, we're going to look at the futures, which is the first instrument that we analyzed. So we're going to go /VX /VX, and that's going to bring up the active month for the VX futures. Okay, so we don't need to know which one it is. In this case, I've changed it here so that it shows me all of them, but you can just have the active only or 3 months. So I've picked all so we can look at all the different values of volatility. In this case, the active one is the one expiring in October with 20 days to go, and is the actual code or the actual symbol is /VXV20. That's the active month. Okay, this one is very liquid. You can easily trade in and out of it. As you can see, /VX, so the VX futures have no options. If you want to use options on VIX, you have to go and actually use the VIX options, not /VX options, because they don't exist. Okay, so what we're going to do now is we're going to buy a future, and we're going to see how it moves, see if we can get some fluctuation in the market so that we can see how it moves in terms of its value. Okay, I'm going to pick November with 48 days to go. I'm going to buy this particular month. So as you can see here, another thing that's important to notice is that the values for the different months, these are the weeklies, this is the monthly, this is another weekly, and all of these are monthly. So you can see that the value of the futures contract is not the same for all the different expirations. We have the a level of 2960, 3050, 3060, 32, 3055, etc. So those are all different. And one thing we notice is that the highest point is the November future. Why? Because that's when the US elections are going to happen. So there's an anticipation of volatility for that month, and then it starts going down after that. Okay, so we're gonna buy the November one, and if you want to buy it, what you do is you click on the ask, and now we're going to look at this position, and we're gonna see what we're gonna do. We're gonna buy one futures contract for November, VXX20, which is the code for the November future. This is not the active one, but we're still going to buy this one, 32.85. If I hit confirm and send, this is the buying power effect. This is the margin that I need to put up in order to initiate this trade. I'm going to just go out and buy the future. Okay, so I bought the future now. So I'm going to come here and I'm going to see my position, which is this one. And I have a previous position. So what I'm going to do is I'm going to move it to this group so that we can take a look at it on its own. So this is the trade that I just put on, and it is /VIX. I have the this future, the November future. I bought one futures contract at 32.75. It's marking now at 32.82. So I have 7 cents of profit. And 7 cents of profit, we mentioned that the size of the futures contract is 1,000 per the multiplier is 1,000. So it's 1,000 per 1 unit of VIX future per dollar. So 7 cents of profit is reflected in a profit of $70. You can see here. So in this contract, I'm already having a bit of a profit right now. I could just close it, or I could hold it, and if it gets to expiration, when it comes time to settle this, and it's going to be cash settled, we're going to compare if the VIX is actually higher than 32.75. Let's say it is 42.75, then I'm going to make $10 and I'm going to receive $10,000, and the cash is going to go to my account. Okay, there is no deliverable. This is just a financial instrument. It is cash settled, and this is a futures contract. So this is how you can trade the volatility futures, the VIX future. Okay, this is how the futures contract could be traded. In this case, I bought it, so I'm long this future. You can see how it's reflected in the P&L per day and P&L open, etc. Now, what we're going to do is we're going to go to ETFs. And we mentioned that we have several ETFs that we can use, ETFs or ETNs. So we're going to start by using the most liquid one, which is VXX. So if I go VXX, first we're going to take a look at the chart. And the chart, as you can see, it tracks the VIX spot pretty closely. I mean, there is some deviation, but it's pretty closely. I mean, the overall direction of VXX is the same direction as the VIX. You can see here what we mentioned when we talked about this. When VIX is stable, you shouldn't be losing money, but in the VXX you start losing money because usually when there's stability, the term structure of VIX is usually in contango. So you start having to, at every roll you do, and you do rolls daily, you're going to have to be, in this case, selling the cheap one and then buying the more expensive one, which is the one in the back. So because of this, there is some contango drag built in, and you can see it here. Once the market started going higher, then the VXX probably actually outperformed the VIX because the market turns into backwardation. So the front month starts going much higher than the back month. So you're selling the more expensive one and buying back the cheaper one, which is going to give you a profit. So when the market is stable, which is around 75 to 80% of the time, the market is going to be in contango, and the contango affects the returns of VXX. In this case, what we're going to do is, VXX right now is trading at $25. You can buy it. Actually, what we're going to do is we are going to see that VXX itself has options, but these ones are not like VIX options. They're not cash settled. They're not European style. These ones are American style, stock settled. So the same way you trade Apple or Microsoft or any other equity, this is the same way you're going to trade these ones. And also VXX is a short term. This is the name of the actual instrument. It's the short term ETN. So it's an exchange traded note. For our trading, it doesn't make any difference, but it's not an exchange traded fund. It's not backed by anything. It's just a note. It's debt that is being floated and that is being converted into a tradable instrument. For us, it makes no difference, but it's important to keep in mind that this is an ETN and it might have some fiscal in terms of tax ramifications. So what we're going to do now is we're going to trade VXX, and in order to show that now you have a tradable underlying. This is not like VIX options, remember. So you have a tradable underlying, so you can do a cover call. And the way to do a cover call, you buy the stock and you sell an out of the money call on it, and it acts as it's a synthetic position that's synthetically the same as a short put. But we're gonna do it with this so that you can see that you can combine the stock with the options on VXX the same way you do it with a regular stock. So we're going to open up the November expiration, and what we're going to do is we're going to pick the 30 delta, so around the 35, and I'm going to do a cover call. So I go right click on the mouse and I go buy a covered stock. Okay, so I'm going to be buying 100 shares of VXX, and I'm going to be selling the VXX, the November expiration call, the 35 call. I'm going to do it for this debit, so it's already considering the credit from this call that we're selling. So I'm just going to execute it, and in order to get it filled, I'm going to make sure we fill it. Okay. Okay, so we got filled. And here's what we're going to do. I'm just going to move it to our VIX trades. Okay. So now we have the future right here, and we have VXX. And for VXX, we have the 100 shares of VXX, and we also have a short call with 50 days, and we traded it. We actually sold it for 177. This is what it's marking at, and we have the different all the different parameters. Okay, the P&L per day right now is $4, so we're making $4. Remember, this is a bullish position on VIX, which is a bearish position on the market, because the VIX moves opposite what the market does. okay? And even though we're doing a covered call, we still have positive delta. So we're long volatility with this one. We have some other products, and I'm just going to show you that you can trade them as well. UVXY, which does the same thing, but it's leveraged 1.5 times the VIX. Okay, you can go and buy it. It also has options, but you can just go and buy it, or you can sell it. If you sell this instrument short, if you sell UVXY short, that means that you are short the VIX. It means that you're long the market. So we're gonna just take this 100 shares short, okay, UVXY at 2017. I'm gonna be selling it short, so I just want to make sure that I get a fill. Okay, so I send it, and I have now the trade in, I have a trade in UVXY. I'm 100 shares short in UVXY. Okay. And now I don't, with these trades, I'm not depending on VIX, I'm depending on VXX, and here I'm depending on UVXY, and here I'm depending on the future. I'm not trading the VIX directly, but this is the closest you can get to trading the VIX. Same with SPXY. You could buy it, sell it, buy options on it, sell options on it, and this is how you use the ETFs. Now we're going to move on to the third way to trade VIX, which is VIX Options. If you go VIX here, you have all the different options on VIX, and the first thing we're going to notice is that they expire on a Wednesday, but you can only trade them until the Tuesday prior to the Wednesday, because these are AM, so these are AM settled, morning settled. Okay, so these are the options, and you can do whatever you want in terms of option strategies. You can do a straddle, strangle, you can do an iron condor, a vertical. You can do pretty much any option strategy you can think of. You just have to be careful when you sell a call or when you do a long calendar, because the front end of the curve, the front expiration can spike quite a lot. So you can have pretty big profits, pretty much catastrophic losses. So you have to just be careful when you do that. So what I'm going to do here is, this is the VIX. I cannot buy it or sell it because it doesn't have a bid and an ask, because it's not a tradable instrument, but you can do option strategies. So let's take, for example, this one, the short-term one, the October 14th. Okay, so these are, and remember, the VIX is trading at 26.56, but if we go to the at the money bid and ask for calls and puts, you can see that this is not the real at the money, because look at the call. The call is trading for like $4 or $4.50, something like that. That's the mid price, and the put is trading at 15 cents. So you can actually do this as an exercise. You can figure out what the future is trading at just by going down the option chain and see where the values kind of equalize. So in this case, it's between 30 and 32.5. So we know that this future, the October, is probably trading at somewhere a little bit over 30. So if we take a look, let's go back to the futures. It's trading a little bit over 30, exactly 30.60 and 30.65. So this is our at the money. Okay, so let's go back to VIX, and you can do whatever you want with VIX options. Here, for example, what I'm going to do is I'm going to buy a call spread. Okay, so I'm betting on volatility expanding. Maybe it's a hedge for my overall portfolio, such that if the market collapses and my portfolio is going to have losses, at least my hedges are going to have profits. Okay, so I'm going to buy the 30, and I'm going to be selling the In this case, for example, I'm using the control key on my keyboard so that I can add a leg to this trade, and I'm going to be selling the 40. Okay, so what I'm doing here is I'm buying a vertical. I'm buying one contract of the 30-40 call spread with the at the money being around 30-60. I'm buying the 30-40 for 170. This one can expand all the way to 10. So my max loss is 170 and my max profit is 10 minus 170, so around 830. So in this case, for just to make sure that I get a fill, I'm going to reduce the amount that I'm willing to pay. Actually, I have to increase it, don't I? Okay, so I'm going to go $2 to 10. I'm gonna pay the natural $2.15 just to make sure that I get a fill. If we look here, we talked about sizing. Okay, so sizing this trade is easy because it behaves the same way as an option trade would. So you have the 30-40 call spread. It's multiplied by 100. So 10 points in this spread means $1,000. So if I'm paying $2.15, then my break even is $32.15 because I'm buying the 30-40, and my max profit is $785. So this is quite a small trade actually if you compare it to the VIX Futures, which are 10 times the size. So this is a way to get a little bit more granular, and for small accounts, it's a pretty good way to get involved in trading VIX, and not doing it directly with futures, but doing it with options. Okay, so in this case, this is just a long call spread, same way we deal with any call spread. I'm buying the 30-40 for $2.15, $215. That's what I'm gonna pay. It could go all the way to over 40. So it could go all the way to a profit of $785. And this is the trade. It's a small trade. You just send it, and we're gonna have it here. I got a fill, and if you go and take a look, I'm just gonna move it over here. So now you can see that we have VIX trades that have the future /VX, some ETFs, UVXY and VXX, and we have the VIX also. We have VIX options. So as you can see, there's many ways you can play the VIX. There's many ways to trade the VIX, and all of them have their nuances, and all of them have their little details and considerations that you have to pay attention to in order to put together and to initiate a good trade where your expectation for the market movement matches what your trade is doing. So in this case, this is the future. You buy it or sell it. There are no future options, so you can only buy or sell the VIX. This is a pretty big product. As you can see, I'm losing now $120, just like this, like in 5 minutes. Then the ETFs, they behave exactly the way any other ETF or ETN would behave. You buy it, you can buy it directly, or you can establish an options position on these products. In this case, we picked VXX and UVXY. And the VIX, you can't buy the VIX directly, but you can do VIX options. In this case, I have a long call spread here, and it's moving the way a call spread moves based on the values of these options. And these options are taking their values from the futures and not spot VIX. So once you start trading VIX, you have to be aware of the term structure of volatility, of the term structure of the VIX, because if not, you might be right in your assessment, for example, that VIX was going to go up, but it's not reflected in the back month. So you're not going to make money based on your assessment, even though your assessment was good. Okay, even though your assessment was a profitable assessment, there are some details that you neglected to take into account, so that when you actually see it in your account and in your P&L, it's not going to be reflected. So it's important that you understand how those how all these details impact the pricing of VIX products.